All right, what's up, traders? Welcome back to the channel. So we had a really busy week last week. VIX closing up very high. We had a massive drop on the S&P, and Bitcoin did so much nothing. Make sure you stick around. This video is going to be a little bit different. We're going to do the analysis up front, get that done and over with, and then for the last part of the video, which will take up most of the time, we're going to talk about trading psychology. I think you'll like it. Make sure you stick around. All right, first and foremost, the S&P 500 has an expected move of 347 points next week. That is crazy, considering last week we had an elevated VIX and we had like 120 point expected move. Thanks to Thursday and Friday's gaps down, we can see that next week is expected to be a very big range. Now, I don't necessarily know if this is the bottom. Obviously, a lot of people are going to say that this is the bottom. We will discuss it. Right now, your expected move high is going to be 54.21. That's the high edge of the expected move. And the low edge of the expected move is going to be 47.27. Now, with that being said, please do not try to overtrade at these areas, because understand something. When we have an elevated VIX like this, technical analysis, you can just throw it right out the window. This is going to be a very emotional trade, and when you have very emotional trades, specific types of analysis you might have will probably not stop price. Now, that you can watch the levels, just please don't force the issue. And another way that you can help yourself remain profitable in this high volatility is to lower your position size. Though really and truly, there's not a whole lot for me to say as far as where to look for entries and exits next week. It's going to be a trade by feel kind of week. But let's go on ahead and move over to Bitcoin, as that's what everybody wants to know. So first and foremost, right off the bat here, we can see that we rejected from the 21 exponential weekly moving average. This orange line up here is the weekly 21 exponential. I'm only showing you that to say this. The week prior, we tested that and failed here. So everybody was looking for that downside continuation this week. We had tariff talks, or an announcement of tariffs, on Wednesday, and that created a massive bout of volatility. So much so, we traded all the way back up to the weekly 21, and we firmly rejected that area and have since moved back down. Now, after that, we have went nowhere. Even though the risk markets have collapsed and the VIX is in such elevated territories, we've only been up here 12 other times in all of history, Bitcoin has done nothing. So be very, very careful. There are going to be people out there saying that Bitcoin is showing us relative strength because everything else has shit the bed and Bitcoin is holding support. Therefore, it is stronger than everything else. I would argue that it's just a very crowded trade. Everybody is trying to short this thing right now. And since everybody is on one side of the market has to find that imbalance. And only then will it reprice higher or lower. Nobody knows what's going to happen. That's the kind of atmosphere that really makes me want to look to be a buyer, because the sentiment is so bearish out there right now that everyone is looking for Bitcoin to literally crash. And it could. You have an elevated VIX. You're up. Where did we close on Friday? We closed at $45.30. Look at that nasty candle. Yeah, this is world is ending type of volatility. Now, when I said that we've only seen this 12 other times, here they are. You don't have to take my word for it. This is the entire history on the VIX. This means there's no more data. Goes back all the way to 1990. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. No, 10 other times in history we've gotten this high. I believe that's the last unfilled gap. So now the only unfilled gap is down here and down here. So you got two unfilled gaps very much lower. All the unfilled gaps to the upside have been filled. So typically volatility does spike and then go lower. But I want to show you, like back during the financial collapse, it can stay elevated for a very long time. Here was a time when it spiked, went all the way back down to 25 and then shot up to 90, so, or 85, whatever, 86. So be very careful. This downside might not be over, but I would be willing to say we're probably closer to a low being in now than we were last week. I mean, that's obvious. That goes without saying. But anyways, here we are on the analysis. We have a triple bottom down here. This day, March the 31st, did not touch these lows, but it was close enough to call that a double bottom. And then here we go on Thursday, April the 3rd, we hit it again, did not liquidate that. And we did not liquidate it on the futures either. So, or on at least the futures platform that I follow, which is weeks. There is a link in the description if you want to trade on weeks. If you do use the link, please, please only put an amount of money on exchange that you can afford to lose. But anyway, this did not liquidate. You can see there's black space there. So my whole thing before looking for bids is I would expect this to at least at the very minimum liquidate this triple bottom down here. Now, it doesn't mean it will, and it doesn't have to, right? Because it's going to be very emotional next week and probably for a few more weeks to come. When this is happening, you just have to find the best areas that you can put on risk. Make your positions smaller because moves are going to be much bigger. Bitcoin will break out of this range. It will break out either to the downside or to the upside. The negative sentiment out there, obviously the technicals and a lot of other things suggest that you should be looking for downside moves. You're in a downtrend. You're down on the year. You are trending lower. Right here is April's open. This is Q2's open. So we're not bearish on the quarter objectively right this second, but anywhere below $82,549, you will be objectively bearish on the quarter and bearish on the month. So just to say that means it is trending lower, but you are in a 4-week range, 5 weeks range. Since we broke down here, set the yearly low, we've been trading in a range from $88,000 down to $76,000. But the majority of the price action or the majority of the trading is happening from 80,000 up to 88,000. That is the range we are stuck in. And 1, 2, 3, 4, 5 weeks. We're about to close out the 5th week. So, and I mean, it does look bearish. It does, no doubt. You're rolled over. Every indicator you look at right now on a weekly and daily time frame is going to say it's lower. Now, with that being said, it does look like the bears just do not have the juice to push this thing down. It could literally mean that buyers are propping it up. It could also literally mean that the trade is too one-sided. There are too many people looking for the short. So Bitcoin may need to go up to liquidate some early or near-term traders in order to get that imbalance going to force price to reprice lower or reprice higher. On the technicals, there's really nothing for me to tell you other than it's in between the 50 and the 40 on the RSI, which indicates that on the daily time frame, the bears are in control of momentum. On the weekly time frame, the bears are in control of momentum. You are below your weekly 21 exponential. You are below your daily 21 exponential. You have rejected both of those averages a few times now. Just like I said, the bears can't seem to get anything going. Neither can the bulls. Bitcoin is just literally trading sideways, and it's very boring. You would think with the S&P 500 being down 5.97% on Friday, that Bitcoin would be down at least 10%. And it's not. Prepare thyself for a large move incoming on Bitcoin. Right now, I am watching that 21. If we close a daily above it and we get bullish continuation, then I can potentially start to look for long day trade scalps. If Bitcoin continues to close dailies and weeklies under the 21, then obviously I need to look to sell resistance for any potential downside move coming. All right. But I'm going to say this one more time. Nobody knows what price is going to do. You know who's been making money? The scalpers, because we get in and we get out quick. We're not looking for that home run trade, whereas everyone else is, and they're getting chopped apart. So if that is you, stop looking for the home run trade. If you get into a position and price moves in your direction, make sure you take profits quickly and move your stop. Manage the trade. With that being said, we're going to move on and we're going to discuss trader psychology. The anchoring effect is where traders fixate on an initial piece of information, often a price, and let that disproportionately influence their decisions, even when new data suggests otherwise. Here's an example. Suppose a trader, let's call him Mike, is eyeing a stock, let's call it Green Energy Corp, that he first noticed trading at $100 a share a few months back. That $100 price becomes his mental anchor, a reference point he subconsciously uses to judge the stock's value. Fast forward to now. Green Energy has dropped to $70 due to a market downturn and some operational hiccups. But Mike sees it as a bargain. He thinks it's way below its real value of $100, so he buys 50 shares, expecting it to rebound to that original price. Here's the anchoring effect at play. Mike's decision hinges on that initial $100 price he saw, not necessarily on the company's current fundamentals, like declining revenue or a shaky industry outlook, which might suggest $70 is still overvalued. A week later, the stock dips further down to $60, but Mike holds firm, convinced it's undervalued compared to his $100 anchor. He might even ignore analyst reports pegging the fair value at $50 because his judgment is tethered to that first number he latched onto. In this scenario, the anchoring effect clouds Mike's ability to assess the stock objectively. Instead of adapting to the new information, he's stuck on the past price, potentially leading to poor trades like buying too high or holding too long. Traders often fall into this trap with historical highs, entry prices, or even the big fig, round numbers, letting those anchors skew their perception of what is or what is not a quote-unquote good deal. Gambler's fallacy. Meet Jake. Jake's been watching Bitcoin on the 1-hour chart. It's dropped for 5 straight hours, from $60,000 down to $58,500. He thinks it can't keep falling forever. 6 drops in a row? Are you kidding? This thing has to bounce. Convinced the streak has to break, he buys a half a Bitcoin at $58,400, expecting a quick reversal. But the next hour, Bitcoin dips again to $58K. Jake is now down $200 and baffled, muttering, "It's gotta pump now. The odds are in my favor." This is the gambler's fallacy. Jake assumes a string of losses makes a gain more likely, as if Bitcoin's price owes him a rebound. In truth, each hour's movement is independent, driven by market forces, not a cosmic need to balance out. His bet is based on a false pattern, not reality. The contrast effect. Sam's been tracking Bitcoin, which has been stuck around 59K for days, barely moving, feeling stagnant. One morning, it jumps to 60K after a positive tweet from a big influencer. Compared to the flat 59K grind, that $1,000 spike feels massive to Sam. He thinks, "Whoa, this is a huge breakout. Bitcoin's taking off," and buys 1 Bitcoin at 60K, hyped by the sudden shift. This is the contrast effect. The modest $1,000 gain seems way more significant because it's juxtaposed against the dull 59K plateau. In reality, it's just a 1.7% move. That is normal volatility for Bitcoin. But the contrast warps Sam's perception, making him overreact and jump in without checking broader trends like a looming resistance or a moving average or any technical thing. Confirmation bias, and one of my favorites, Confirmation bias is a cognitive bias where people favor information that supports their existing beliefs or assumptions while ignoring or downplaying evidence that contradicts them. It's like wearing blinders. You see what you want to see. You filter out all the rest to avoid challenging your worldview. In decision making, like trading, it can lead to skewed judgments and missed opportunities as individuals cling to their narrative even when the facts shift. Here's a small example. Tom, a Bitcoin trader, believes Bitcoin is in a bull run, aiming for 70K. He's obsessed with price action, swearing by a pattern. When Bitcoin breaks above its 50-day moving average with high volume, it jumps 15%. I saw it twice last year and now spots it again at 59K. Breakout confirmed in his mind. He buys one Bitcoin, hyped up. Next day, it dips to $58,500. Tom brushes off a bearish RSI divergence, instead fixating on a tiny volume spike, thinking, this is just like last time, still bullish. He skips news about a whale dumping 5,000 Bitcoins, focusing only on the past chart that fits his story. Even as it falls down to $57,000, he holds, convinced this is going to work. His price action read is golden. Tom's confirmation bias locks him into seeing bullish signals, ignoring the cracks in his analysis. Cognitive dissonance. Cognitive dissonance is the mental discomfort or tension that arises when a person holds two conflicting beliefs, attitudes, or behaviors, or when new information clashes with an existing belief. To ease this unease, people often rationalize, deny, or twist reality to align the conflict rather than change their stance. It's like trying to force a square peg into a round hole. You'll bend the peg or the hole before admitting it does not fit. Here's a small explanation. Meet Mark, a Bitcoin trader, prides himself on his price action skills, believing he can predict pumps with precision. He's sure that when Bitcoin forms a cup and handle pattern, it's a lock for at least 10%. Spotting one at 58K, he buys one Bitcoin expecting a $63,000 800 price target soon. The next day, Bitcoin drops to 57K, patterns failing. Mark feels the dissonance. His belief, I'm a great price action trader, this pattern works, clashes with reality. It's not working, he's losing. Instead of selling, he rationalizes. It's just a deeper handle, still valid, ignoring a bearish volume drop. As it hits 56,000, he clings tighter, cherry-picking a minor bounce to 56.2 as proof it's turning. Mark's cognitive dissonance drives him to twist the price action to fit his self-image rather than admit his call was off. The Baater-Meinhoff phenomenon. The Baater-Meinhoff phenomenon, also called the frequency illusion, is a cognitive bias where something you recently noticed or learned about suddenly seems to pop up everywhere. It's not that the one thing is actually more common, your brain is just primed to spot it now, amplifying its perceived frequency. It's like buying a red car and then seeing red cars all over town. Your awareness, not reality, has shifted. Meet Luke, a Bitcoin trader, has been honing his price action skills. Last week, he read about a head and shoulders pattern, a reversal signal, and nailed it once Bitcoin dropped from 60,000 down to 58. Now he's obsessed with finding it again. Trading at 59,000, he squints at the chart and spots what he thinks is a head and shoulders forming. A peak at 59.5, a dip, then a lower peak. He shorts one Bitcoin expecting a massive drop. Over the next day, Luke sees head and shoulders everywhere on a 15-minute chart, on a 1-hour chart, even a random altcoin he checks. Bitcoin dips to 58.8, then bounces up to 59.2, costing him $200. Still, he's convinced the pattern's rampant, muttering, "It's all over the place. I'm on to something." The Baater-Meinhoff phenomenon has Luke fixated. His new lens will make every wiggle look like his pattern, even when it's just noise, not a real trend. The paradox of choice phenomenon. The paradox of choice phenomenon occurs when having too many options leads to overwhelm, indecision, or dissatisfaction, rather than freedom or happiness. Popularized by psychologist Barry Schwartz, it suggests that while some choice is good, an excess can paralyze decision-making or make you second-guess your pick, fearing you missed out on something better. It's like standing in a candy store with 50 flavors. Too many options can freeze you up or leave you regretting your chocolate over caramel. Over here sits a guy named Ryan. He's a Bitcoin trader. He relies on price action to trade Bitcoin. It's currently at 58 grand. He's got a dozen patterns in his toolkit. Head and shoulders, flags, triangles, double tops, moving average crosses, you name it. One day he sees Bitcoin stalling near 58.5. He wants to trade it, but now he's stuck. Is it a bearish wedge signaling a drop, or is it a bullish flag signaling a pump? Maybe a triple top, or is it just consolidation? He's got too many ways to read it. The paradox of choice hits Ryan. Can't pick. He hesitates, overanalyzing every candlestick, worried he'll miss the perfect signal. Bitcoin dips to 57.8. He thinks wedge, but then it bounces to 58.2. He regrets not seeing the flag. He finally shorts it at 58, but it climbs to 58.7, costing him $700. Frustrated, he mutters, "Too many damn patterns." Ryan's glut of price action options leaves him paralyzed, then dissatisfied, proving less might have been more. These are just a few phenomenon that occur inside the human mind. There are many, many more. These are all well-researched behaviors. Trading psychology is so very important, guys. It is the most important thing to this game. You are trading against the richest and smartest people on the planet. I don't care how educated you are. When you become a trader, hopefully you will find out that you cannot predict a damn thing. There are too many factors associated in price movements. I don't care what your pattern suggests Bitcoin might do. That will not be the reason you make money. The reason you make money will be because where you entered, price moved away from your entry in the right direction. That is why you made money. You didn't make money because there was a pattern happening. You did not make money because you knew what was going to happen. You made money because you came along, applied risk in the open market at the right time. That's why you made money. Nothing to do with what you know. It has everything to do with where you applied the risk, when you applied the risk. There's going to be many times you're going to apply risk and you're going to be wrong. And I hope, just hope, that trading psychology does not get you to the point to where you blow your account. Make sure you guys trade safe, trade smart, and as always, happy trading, everybody.